everybody and welcome to Breaking the Mould. My name's Clara Hermit and of course joining me today I have Russ Mould, our Investment Research Director. I've just come back from holiday.
Looking good, looking well.
Thank you.
Pleasure.
I enjoyed it, the sunshine.
Yeah.
But there must be some fuss here, Russ. What is it?
Always fuss here, and the fuss this week is crash barriers, buildings, Burberry check. Just for you.
That last one sounds particularly exciting and I think that's a good place to start.
Okay, I thought the catwalk stuff would get you all hot to trot after a couple of weeks off. We've actually got Burberry's full year numbers on Wednesday the 21st, and for the first time since 2006, the luxury goods leader will be producing numbers without Angela Arendt as the boss. Now she's gone to Apple to be head of retail, very high profile job, reflection of what a great work she's done at Burberry, and she's been replaced by Christopher Bailey, who's also the company's chief creative. Nice title that, isn't it? So the full year numbers, they've already given us a second half trading statement, and so we've got a bit of a flavour of what's coming up, and there are three issues we all need to watch. One, the performance of Beauty, their sort of perfumes business, which is the fifth official product line now, alongside women's wear, men's wear, children's wear and accessories. The second thing to watch is rollout of flagship stores in key markets like China. And the third, on a related subject, is what's the impact of the emerging market upset that we saw last year? We've talked about a lot on these shows. And have they seen any softness in China in some of their biggest markets? Before she left, Angela Arendt said that currency movements had, quote, a material impact on the business because 40% of sales come from Asia. That's why the market's looking for about 7% growth this year that's just finished, 6% the year that's just beginning. They're good numbers, but actually nowhere near as the double-digit run rate that we've used to seeing previously. So it'll be interesting if Bailey can sort of reinvigorate things. And in the end, if the emerging market story turns around, Burberry's probably one of the first stocks that the investors will look to, simply because even in the FTSE 100, there aren't many companies with its brand strength or therefore pricing power.
Now Russ, I could talk luxury goods for absolutely hours.
I just have.
Well, that was a few minutes,
okay.
But time is against us,
okay.
as we know. So let's shimmy on to the topic of buildings.
Tall buildings, yeah. Now houses have obviously grabbed all the headlines this year. House price increases of around 10%. It's been a bonanza for the Daily Mail headline writers. But commercial property is also on the up, which isn't getting as much attention. Now, from an investment perspective, this is very interesting because house builders' share prices are pretty much at the all-time highs we saw pre-credit crisis in 2006-07. The big commercial property players, nowhere near. Some of them are even half as high as they were then.
So why is that?
Well, it's a good question. I think firstly the house builders have cleaned up their balance sheets. They've paid off a lot of the debt that frightened the living daylights out of people 7 years ago. And the commercial property players still do have some quite big liabilities. And also I think people just aren't that convinced the recovery's that sustainable, to be honest with you. If it proves to be so, the big commercial property players are very logical beneficiaries. Companies like British Land, Land Securities, Great Portland. Now they all report numbers in the next fortnight. British Land on the 14th, Land Securities on the 15th, Great Portland on the 21st. Three simple things to watch here: rental growth, occupancy rates, and net asset value increases.
So that's buildings. So we've done trench coats, tall buildings. Shall we press pedal to the metal and move on to crash barriers?
Love to. And the company we're talking about here, big change of pace. We've talked about lots of FTSE 100 companies. Now we're going down to the FTSE small cap to talk about Hill and Smith. Based in Wolverhampton, it actually has operations in 7 countries worldwide and is a leader in crash barriers, safety systems for motorways and buildings, and also its products are used to improve traffic flow, which, let's face it, is something we're all probably in favour of.
Yeah, indeed.
Yes, so we've got an annual general meeting from them and a first quarter trading statement on the 14th. Now, their second half numbers were a record for the company, so things look to be going in the right direction. And the UK government's opening up the public purse to build an awful lot more roads from 2015 onwards, or expand ones that were already existing. More building work, more crash barriers. Mm-hmm. So the market for the year that's just finished for this year is actually only just looking for around 2% earnings growth, but for next year it's looking for 10. So that's a pretty good set of numbers, and also very, very good track record of dividend growth at the company. So again, if the government really does start to spend, and you see improvement in France, which is a business that's been holding them back, then Hill and Smith, it could be pedal to the metal time.
Wow, woo-wee. Thank you very much,
Pleasure.
Russ. So that has been Breaking the Mould for this week. We will be back in 2 weeks' time with lots more exciting stuff for you. In fact, who knows what we'll have in store? You'll have to join us to find out. Goodbye.